Kansas City focal. It's another day, another day of in the house, locked in. We can't get anywhere, but we're just looking for the light at the end of the tunnel. And of course, we're hearing all of the politics that's going on. We're able to see it a little bit more quicker than we would at the job, even though most of us are either working from home or some type of inconsequential off on between going into work and not going into work shifts. And here goes the paradigm for us. Now we're entering a new phase where we're starting to see where our banks are feeling where we may head from a real estate perspective. The last couple videos I kind of give you interest scope. Oh, this is where I think we'll land. Percentage loss gain. What can you do to protect yourself? Because no one has the golden globe or crystal ball in their hand that can tell you what's going to happen. Anyone that says that to you, I think should be looked at with a really squinted eye, because I think they're telling you a lot of wrongs. Now, forecasting, yeah, we can look at the past and take a look at that and say, well, these are some of the areas that I've seen previously, and they mimic what we have now, and we could possibly go this way, but every situation is different. So now, off on my spiel, you're looking at the page, you're looking at the research real time. That's real estate news and investor news. That's the purpose of this podcast, essentially news iteration. J.P. Morgan, big guy, number 4 bank in the freaking United States. They may be number 4 in the world. Let me. That's a lie. I wouldn't do that to you. So number 4 bank, 4th largest, in the USA. They have taken the initiative to tighten their lending standards. So everybody thinking they have a plan. So here goes a lot of the plans that you see when we talk about lending standards. A lot of folks will then move to, if there's a job loss looming or potentially loss of home value, and they really can't get out of it because essentially there's a feeling, I'm going to lose everything. I might as well take from the bank and get all that I can, at least to have a backup fund or potentially whatever else you figure out you think you can do with that money. Maybe put down another house payment for a newer home that's a lower cost, and then you do your dollar cost averaging, and you say, oh, you know what? I lost on this one, but this one came in lower, so I'm pretty much even, right? Kind of like the stock market, credit spreading, whatever you want to call that. J.P. Morgan's new regulation, 700 credit score, and a requirement of 20% down. Okay, that's a big change from a lot of lenders. Now, they don't specify if this is still regulated to the FHA group, which has always had a lower down payment. This is, from my understanding, this is just for a conventional loan. Leave your comments below if I'm incorrect. So conventional loan now, used to be, I believe it was 5 or 6% down in some snippets. I think J.P. Morgan, they play with the 15% range. If you went through a bank, third parties are like between 4.5% and 5.5%. Again, I'm throwing a number out there. If you go through a third party that buys it and then sells it off to an investor or a bigger bank, these guys were at the probably at the 15 percentile, 20 percentile. Some great credit holders got a lower rate than that for down payment. But now that's out of the door. They see tailwinds in the system, and they are now saying you need a 700 credit score and you need about 20% down. Okay. In addition to that, they are also in the market. They are also normal people walking the streets like me and you, so they have a vantage point just like we do. You're not going to sneak up on these guys. And now the HELOC loan, basically home equity loan, which is basically used by some guys to use your house as a bank and pull in whenever you need, that is now going to be scaved off. They're going to pause that for a while. A lot of folks are doing the refinance thing, cash out refinance, take some cash out, get the value of your home. JP Morgan's going to focus on that end, but that is a huge hit to some of these guys that were using their home kind of as a bank and taking what they needed as they needed. Now it's, you better figure out what you need in the refinance cash out, and that's all you got. And it's a different kind of game. And with the upcoming big layoffs that we saw in the previous week, we'll look at that in a second. there's no wonder why banks are starting to tighten up and say we got to protect ourselves because these folks could come after us and we could be in a bad situation. So that's what we're seeing, the tightening of the market. There's also some other lenders that are throwing out there, you know what, on top of these new credit score ratings and 20% down. By the way, this normally, if you go to any other country, I hate to say it, outside of America, this is normally what they like to see. All right, if it's not cash. All right, some of these foreign countries, it's cash. You got to pay the thing off, right? So this 20% down, that's probably normal habits of buying a home. That's what it's supposed to be. And then 700 credit score, that's also something that you usually see in foreign countries, but now USA is catching up, a capitalistic country starting to slow down. So it's interesting to see that. Now, jumping over, I had some more news that I wanted to focus in on. Yeah, United Wholesale Mortgage, thanks to Housing Wire, and then you saw the Real Deal here. I love these two websites, especially New York real estate. I'm a native of New Jersey, so I feel the New York, LA, they're sometimes the pulses of where we may head. So United Wholesale Mortgage, okay, here goes another thing. Okay, they have now stated that if you buy a home, a little trick, I'm about to get laid off in about 3 months. So if I get the loan now and I close maybe on that third month, I should be good to go, even though they could lay me off on that day. Guess what? 2 sneezes on that one. Excuse me. On the day of the loan, they are going to re-verify that you still have employment. Okay? Let me read it out. The second biggest mortgage lender in the country, United Wholesale Mortgage, recently announced that it will require re-verification of a borrower's employment on the day their loan is scheduled to close. That is a game changer for a lot of folks. Game changer. Game changer. Fannie Mae and Freddie Mac. And all I'm showing you is these requirements may start to flow down. Okay? May start to flow down to other lending entities. All right. The other big thing, it should be noted that the changes do not apply to Chase's Dreammaker mortgage program, which makes loans available for low to moderate income borrowers with as little as 3%. That's a good nugget I didn't read before. So again, I mentioned FHA. They're saying, hey, if you're a starter and you need to get this going, you still have the opportunity for this 3% down. I'm assuming this is tangled in with the FHA loan, which is obviously insured by the government. So obviously you'll say, hey, I'll take the risk there because the government's insuring me. Now, going down, Freddie Mac and Fannie Mae, employment verification also announced, right, they changed the age of document requirements for most income and asset documentation from 4 months to 2 months. So they need 2 months. Okay, 2 months of income verification. What that means is all income and asset documentation must be dated no more than 60 days. It used to be playing around. You could probably nugget it in. Let's say today's is April. Here goes my January pay stubs. You good with that? And they used to go, that'll work. Now they're saying I need 2 months, 2 recent months. Now, I've never seen that 4-month deal, so it doesn't impact what I've seen. I've usually seen, give me your recent pay stubs for the last, 8 weeks. Sometimes 4 weeks, 2 pay stubs. But, hey, this is another nugget here. They're saying, hey, we're starting to tighten up. We're afraid of what's going to happen in the market. So off of that rant, we get to see what's happening with the lending practices. Now we look at the numbers. Nearly 3 million borrowers are already in forbearance. Now, is this folks taking advantage of the government's plan to kind of, again, hold off on everything and put a pause to the market due to the COVID ignition? Possibly. That's the sad thing. This number will never know if borrowers have the money and they're just obviously saving up and waiting for the storm, or they're truly out of work. Now, when we look at the unemployment numbers, which I believe is around 16 to 20 million for claims, and again, claims, there's a lot of tricks to that game. I don't want to go into that about the fraud that can happen with unemployment. A lot of fraud can happen there, folks. I'm serious. It's scary. It's scary. I always urge folks, if you want to know about your area, look around and ask around. look around and ask around. Don't always go by the media, because your area may not be impacted the same way a New York City is impacted, or I'm making it up, Dallas, Texas, Atlanta, Georgia, right? Every area is independent of itself, even though they usually have the same amount of trends. There's certain localities that will be different, okay? So always make sure that when you see, okay, 3 million buyers are already in forbearance, what do you see? Do you have a rental and people are starting to say, hey, I can't pay it? Do you have friends that have rentals that are saying, folks are saying they can't pay it? If you're not seeing it in your particular areas or your zones, again, you have to take this with a grain of salt. But it's also a number. I'm a data guy, so I have to look at it. I see 3 million bars there. I say, okay, we're in the middle of the eye, and we're trying to figure this out right now. That's huge. That hurts a lot. Obviously, Black Knight, 1.4 billion borrowers whose mortgages are backed by Fannie and Freddie Mac are already in forbearance. It exceeds the number that they initially wanted. Okay, so talking about numbers, right? We talked about this. I love Housing Wire, one of my favorite websites. I love the Fed website. So now, tightening lending standards. We went into all that. We talked about the forbearance of renters and who's paying and who's not paying for renters as well as homeowners. Now let's look at what happens when the lending standards tighten up, and when does it usually happen, and we look at it as a whole number. If we look at it from 2008 to 2000, I'm going to give it 9, we had the big crash. And then, again, obviously, lending standards started to creep up. If you believe that right now in 4/19/2020, we're probably somewhere around here, just put it here, right? I'm making the assumption that everyone that's listening to this video understands that on top of the COVID-19, there was already an economic slowdown well underway. All right. So with that said, if we're right here, we got a little bit of time. We got a little bit of time to reach this stage, obviously. Okay? A lot of folks are saying we're already here at this stage because it's moving so fast, the stock market drops so fast. However, there's a lot of untruths there, right? They're thinking we're right here already. I don't know if real estate will ever flow that fast. It's so difficult, especially with the forbearances. Let me give you another thing to think about. How fast can they kick you out of a home? Not a rental. How fast can that happen? How many missed mortgage payments does it take? It all depends, right? Processing time. I could probably go 3 or 4 months with receiving letters. Hey, you need to pay your loan. And then maybe another 2 or 3 months after that, right? To get you're going to be kicked out. You know, that's 6 months. You're looking at 6 months turn just to see that activity. So this data is great. It gives us to show us when it started tightening up for loans, right? Hey, wait, you're not getting a loan in '08 right here, right? You got to be perfect to get a loan in '08 in a situation that you're in. That was a crash, right? But look how far down we go, and compared to '08 in first quarter 20, the lending standards needed to be tightened at the end of the day. We went through it's 11 years of basically easing in the lending standards. 11 years. So we had our opportunity. Everyone says that. The opportunity was there. If you didn't take advantage of it, that's tough. Now let's break down. I love the National Association of Realtors. I really appreciate their data. And I can't show too much of this again. You can go on their website, realtor.org, and get some data points and understand where we're at in the market. It's free to the public. But how does this 20% down payment really affect us, right? Median percent down payment by first time and repeat buyers. Okay, look at this chart that kind of shows of where we have been at from 89 to 2019. I love charts. All right, so 89, our lending standards was up there, right? For all buyers, they had to put down 20%. I mean, that's where it was at. Okay, back in 89. All right, and if you go down, it dropped down to 91 after that 87 crash, right? Down to 11% to try to get that boom, 12, 13. It jumped back up to 19% in the crash in 2001. As you can see, when there's a crash, this was the 87 deal, right? That was the tail end of the 87, and that's why it was up that high. And then they lower it when the economy gets better again, but it doesn't last too long. Look at the 2001 crash. It took about 2009 to get down to the 9% range, and then it went downhill from there. And I'm looking at all buyers as an aggregate. First time buyers have always been the highest 11, it looks like 10%. So that's not bad. If you're a first-time home buyer, Advantage serves you. You still got the opportunity. Repeat buyers, again, it's this blue line is the aggregate of the repeat buyers versus the first-timers. So if you look at the repeat buyers, 25% was the highest it was ever, and that was in 2001. So will we go back up here? It looks like the trend is probably going to boost back up, right? With this being another recession point, just based upon the data, maybe a minor slow recession, and then obviously real estate is it's not a leading indicator; it's a lagging indicator. So it's not going to happen right away. Real estate will probably be the last guy to fall. It's much slower due to the cycle, right? How long does it take to buy a home? I can buy it today. No, even if you have cash, you can buy it today. A lot of paperwork to do, maybe a monthly close and all that activity. All right, so sources of down payment, very interesting, right? In 2000, 60% of all buyers received a gift, right? Then they got 32% of home buyers, first home buyers, or 8% of repeat buyers received a gift or loan from a relative or friend. So that's an interesting play right there. 32%, right, needed somebody to help them out. All right? 32%. That's a scary number. And then 19 of everybody, 16% say, hey, I need some help. I need some help to get this out. So those guys I'm worried about. All right, 2009, look at that, 36% needed some help. Look at this. I mean, that's scary. Scary. And that's their first time. Well, repeat guys didn't need as much help, right? They had the equity there. They said, I can play with it. And then 2000, what's this right here? 24% on the blue line of all buyers need some help there. So very interesting play. Very, very interesting. And we got to look at that. Again, great data. I'm reading this. I didn't want to go this far, but hey, saving for down payment was the most difficult task in buying process. Obviously, 13% down. That's probably probably land of sanity, the equator line, right? 13%, it's easy, right? Down payment including closing. That does make sense. Student loans, that's just a great number, right? So here goes. What did they delay to be able to buy a home? All right, it was student loans. Credit card loans were the next most expense that were delayed. So student loan debt is huge. You can see 43, 50, almost 50% of the buyers. If you had a student loan, you said, you know what, I'm still buying. Put that in deferment or forbearance, and I'll get back to them. All right. And the next one was credit card debt. You know what? This home is probably going to make me more money than this credit card debt. And I got an opportunity. It's a great deal. Let me pause on that. That's nearly, I'm going to average out to about 42, 43%. And then last but not least, car loans, way up there. Car loans, almost 35, 36% on average. I'm just doing the math in my head. Again, this is what people had to do to get a home. So interesting numbers. Now we jump into the detail real quick. Let's look at the numbers for this week. Economic calendar, market watch. What's it telling us about the housing market? Everything plays into the housing market. That includes retail sales, all that good stuff, and I'll explain that later. Or not on this video, maybe another later video. Retail sales numbers, all right? So forecast that the stock market or the data team predicted was 7.1. We came in at 8.7, so we lost there. Retail sales to autos, right? 4.5 was the actuals. It were predicting 4.7, so it came in under. Okay. Next one now is industrial production, down 5.4%. They were expecting it only to be down 4.1%, and capacity utilization at 72% versus the 73% forecast. That's in the positive. All right. Housing starts. They expected some work. Here goes our favorite area, right? We're an investor, but really real estate focused. Housing starts, the actuals were 1.2. They were expecting 1.29. So that's a loss there. Building permits, 1.353. So that increased. And then the forecast is 1.25. So you had increase of building permits, possibly folks saying, I need to get this in right now before I lose later. All right, so that's an interesting play. And then we got weekly jobless claims, 5.25 versus the 5. Higher than expected. That's millones. So that's how we got to around the 13 number for jobless claims. So very interesting environment indeed for us in this real estate market. Now, as we take a peek from around the world, Carmen San Diego, I want to look at the total aggregate of trends. We're gonna go to a couple countries. I want to start here. China, okay. China was on a bull run for price index. This is provided by CEIC data, okay. Nominal property index pricing, 119 all up to 138. So they were seeing an increase through 19, and then let's keep going down. But then in 19, they stopped giving the index number for some reason. I couldn't find it anywhere. But here goes trading economics. Let's give you another number. I said let's look at home starts and new builds. Right? How many of that is going on? That tells you some inclination in the market of what's going on. Obviously, more bills tell you more people are coming in. They need houses. 10.7, 10.7, 10.3. Goodbye. Corona 5.3, nearly cut in half for home building. That's an interesting number. Be interesting to see how it reflects on this new chart, which I think obviously will have a downward trend when we look at the home building stats over there in China. Now let's look at the UK, London, another avenue that we kind of peek at. You got again the big five there on that little island. England, United Kingdom. I hate when they separate that. I think they're one and the same. Let's just leave it at that, even though they're not. United Kingdom headed down. All right, they had Brexit though, so that's a different play. But they went from an 8 down to 1 or 2. So there's an opportunity there to buy some property. Scotland's been steady as you go. A little bit of fluctuation, downturn in early 19, and then they stay stagnant. And then Wales has been, I think, to me, pretty stagnant. But then they had the big drop as well. Looks like Corona impact is hitting everybody the same. So no one is secure or free from the coronavirus. There is no way out right now. Let's go ahead and look at some other price statistics that I think are valuable for these talking points. Home prices around the world. I'm going to zoom this in. This is a beautiful chart. I thought it was interesting. A chart that shows rent prices, okay, versus housing prices around the world, and you can kind of match them up together. Everyone thinks America is expensive, but when you're at the same price as a broke Spain, and who else? Poland's there, right? So in the U.S., rental prices are still lower than buying a home at almost 10 points on this chart, okay? Almost 10 points variance. So in the U.S., looks like the rentals are cheaper, obviously way cheaper than actually owning a home. So that's an interesting storyline. That blue circle is indicating the housing buys, and then the triangular circle, not triangular, hexagonal circle is definitely reflecting the rental prices for those areas. It looks like the only good place to buy would be Estonia, right, where rent is much higher than the actual value of the home. And another guy, as we look through, is Turkey. Look at that. Turkey's a bit higher in their rental price versus actually purchasing the home. So there's a couple of areas that do that to you. Looks like Russia's there too. And Russia also has a very low cost of living, so which is a very interesting play and an opportunity to possibly buy. All right. Look at the disparity in Hungary. Lord God, I don't know what's going on there, but that's sick. I wouldn't buy a home there for nothing. Yeah, that's a good chart to just give you an overall look. Looks like everybody's kind of in the same window where rentals are lower than the price of owning, which tells you there could be some price pressures, right? At the top of the hill. So that's across the line everywhere. Now, we jump into the NYC area. I told you I like this area because they kind of give me a pulse. Okay, and we look at sales. I'm going to go all the way to the top. All right. April residential sales down 62%. Okay. Pricing continues upward trajectory. Okay. Sales down for residential 62% in New York City. Pricing continues upward trajectory though. All right. So when you got sales down, that doesn't necessarily mean lower values will come around, because it depends on how much inventory is actually out there. And New York is one of those few places where you're not going to be able to build up anymore. You're going to have to tear down and rebuild back up because there's no more land available. All right, so that's what makes the area special. But as you can see, residential sales have dropped off the cliff in the month of April, and I know we're halfway in. Probably end up here, which is lower than the previous months, but still something that we need to look at as far as potential opportunities to get in. Right, here goes the weekly rate. Again, big drops because of Corona. That's the weekly rate of residential sales. The blue line indicates the 2019. The darker blue is the 2020 data. All right, so these are again all sales figures to help you understand what's going on. There was another pretty good article. Let's see if we can get this one up. Multifamily sales were rising. They were on the incline. So contrary to belief, the thing that no one's buying, that's actually not the case. There are still folks that are buying out there, especially for multi-unit. And real estate is a hedge against a higher dollar volume. So you see that from time to time. So very interesting play there. All right, here he goes. Sales. 1.9 billion in Q1, right? Sales activity remained unchanged, but number of buildings sold jumps 20%. Okay, so that's a great play there in the commercial market. Potentially if this downturn continues, multifamily may be the segment that most folks focus on because hey, I can have one unit and have two persons paying downstairs, and we got three incomes for one place. That possibly gets us over the hump if there's a recession. All right. Now we looked at the mortgage rates. That talked about that. Still low, went down. If you're gonna buy right now. So that's another interesting play. But in all, it's been a great event to kind of watch it mature itself. Best wishes, and I don't want to talk in a way that makes it assume that this is not a big deal. However, there's a lot of opportunity. Could this go lower? Definitely. If the stimulus funds do not work, we're in a whole lot of trouble, right? We're in a whole lot of trouble. You're going to wish you didn't buy anything at this time if that truly happens. But right now, I think the government has a pathway, and it's possibly determined by these forbearances and the money, dumping money in the system. I think there may be an opportunity for an inflation hedge, and real estate could be there as well as gold, silver, etc., and Bitcoin. These are other guys that are possibly available to protect yourself against a potential crash. So there goes the numbers for you. Again, I give you the detail around the world. I gave you UK, I gave you US, and some of the hot markets. Housing Wire was one of the main websites I use. I really love these guys giving me the news right away, and now we can make important decisions. Build This City 23. I'm going to sign off. It was a great talking points. Please leave your comments below. Like, subscribe, and share. I'm out. Peace.